Hi everyone, this is the trading and research team with Canary Capital. Today I have Dylan with me, and we're going to discuss the state of the markets, what's going on, what we're looking at, and potentially what you can use to understand what's going on in the market. I'm going to borrow an analogy from Bill Williams, famous analyst who compared markets to a fish tank, where you have to obviously see if the fish are alive. That's step one. But, you measure the oxygen, you measure the ammonia, you look at the rocks, you look at the plants, you look at the water levels, you do a bunch of pH testing, right? That's, to me, what we're doing here on the technical analysis side is we're looking at a bunch of different stuff. We're coming up with a story and then taking action on that. So we're going to look at a bunch of different indicators. Really, to me, the most important things, which would be trend, where we're at in the cycle. The 4-year cycle crowd continues to win. We're going to look at drawdown, which is not a pretty path as far as depth and recovery after drawdown. ETF flows, on-chain data, and miners continue to be very important, especially in COT positioning. Then we'll round it out with some macro discussion. Classic stuff. Everybody has to have an opinion on rates. Where do you think rates are going? Is that priced in? Where's inflation going? Jobs, etc. The liquidity conversation. Dylan has done some excellent work on M2 and Bitcoin correlations, and there's been more work recently on the treasury side relative to Bitcoin, so we'll talk about that. And because Bitcoin is software, AI and quantum is also in the mix, and there's some interesting correlations there that many people are already watching. And then we'll finish it out with a conversation on DATs, and that is Dylan's wheelhouse, certainly. So for most of these slides, the black background really is for me. A lot of people don't like the black background, but the black background will be TA oriented, and the white background is more on-chain oriented. But just from Dylan's perspective, is this a bull trend or a bear trend that we're in, Dylan? And why do you think that's the case?
Well, thank you for bringing me in. It has been a bear trend, but the difference is now is that, at least in my opinion, just looking at this isolated chart here, we are coming up onto resistance. The left side of the chart, something I always look at, is the resistance and support of the congestion zone that we spent throughout most of 2024 between 50 and 55,000. This is going to be a very busy area. We have approached it rapidly. Crypto usually likes to move quite rapidly through price levels when it's in bear trends, of which it has been for a while, but we've been consolidating at this level for a while. Whether we keep going, we'll see.
Yeah, I'll say nothing good happens below the 200-day moving average. So we are currently deeply below the 200-day moving average. To some people, they would see this as quite a divergence, as in there is potentially a point here where we're due for a mean reversion back to at least the 50, which is the green. The 200 here is the white line. We lost the 200 shortly after October 10th and have since just continued plummeting. So in a way, you just have to read the room. Are the fish dead in the tank right now? They're kind of floating at the top, right? This is classic bear trend stuff. No question about it. We can talk about adoption. We can talk about a million price, BTC price per coin in 2065, whatever, right? We can talk about all that stuff, but in the here and now, over the past couple months, and likely into the next couple months, we are on a path that means lower lows instead of higher highs. And that's what a bear trend is. Lower lows are easier, higher highs are harder. It is easier to go down on bad news. It is harder to go up on good news. That's where we're at right now. And what Dylan was orienting on this left side here, and I agree with, is that we certainly don't want to lose the 2024 consolidation. There's a lot of volume here. There's a lot of people who would be trapped if we quickly fall below that price. And we're already seeing some things like the crypto fear and greed index basically at zero. It's bouncing around 5 to 10 on any given day. So sentiment is already significantly bearish. We are oversold. All of this stuff can be true, but we are also in a bear trend. So again, we don't expect any miracles here whatsoever. I would love to see months of consolidation before moving higher.
And historically, that is what we've seen too. Usually the bear trends have bottomed out and they've taken a while. They'll enter a consolidation range at the market lows and sit there for a while. The optimistic case now if we were to have a series of good weeks in a row, would be we using these moving averages as our bullish targets. So
Right.
it's rough out there.
It's not like, to me, it's not like we're going to magically teleport to 79K and, we're going to figure things out. That's not typically what has happened.
No.
And if we look at the popular price model, the power law corridor, it's probably likely that if we go lower, we break this model, because sure, you can just keep adding, you just keep redrawing the model, right? I mean, that's, I'm sure, what people are going to do, but realistically, we did flirt with a low when FTX blew up in 2022, which we could certainly do here, is, somehow break below the model and then snap back, but not encouraging that we're this early in the trend, potentially to the downside, and we're still, like, we're already way down here on the power law, right? And that's probably because we didn't ever exceed the midpoint on the power law, so we never really saw that explosive move higher, which many people wanted to see.
Yeah, one thing I like to talk about is how, as crypto has grown, as Bitcoin has grown, that ship becomes larger, harder to steer, just because a function of just a larger thing takes more time to move, more money needs to go, things take longer. And that is like a big contributing factor as to why, we didn't quite see the blow off tops like we have in previous cycles, 2013, 2017, et cetera.
Yeah, and I don't have a lot on alts in this presentation, mainly because alts follow BTC most of the time. So if BTC sets the tone, alts aren't going to magically, do much better than BTC. Most of the time, they are just 2x BTC up and down. So if BTC is down 5, alts will be down 10. Typically, that's just what we've seen. This is total 2 ES from TradingView. So this is the total crypto market cap, excluding BTC, excluding stable coins. Again, we're far below the 200-day, far below the 50. To me, as a TA person, TA-oriented individual, I'm not seeing anything here other than a potential bullish divergence on RSI or volume, which would be a lower low in price, higher low in RSI, higher low in volume. That would point to a bullish divergence. So we don't have that yet. Something to look for if we get a lower low here. If you zoom out on this and you go to a higher time frame, there's a pretty clear head and shoulders pattern here as well, which also points to a bearish reversal, which we're in the midst of. So obviously it's a little late if you're looking at this today, catching this, but certainly was telegraphed on Total 2 ES going into the beginning of the year. So alts collectively are unlikely to, in our opinion, just do well based on trend here.
And if that is a head and shoulders, the range of that is quite substantial, I'll say. And so, you're still looking at it could potentially be a substantially more drawdown, because that would only indicate that it's halfway done, given by measuring the head, the size of the head and the shoulders, to that being the measured move of where you're going.
Yeah, I didn't include it in the presentation, but typically you take the depth of the pattern and you measure it to the direction you expect based on the bias. In the head and shoulders case, it would be down. So that would be the depth of this range measured from the neckline lower. So we got some time, right? We got some time to go lower. And again, this is not pointing to anything people don't already know and feel. You can see it in sentiment, but there's just no expectation of random recovery here quickly, in my opinion. If we look at the cycle stuff, there was tons and tons of discussions about the 4-year cycle being dead. It's over. It's dumb. It's stupid. It doesn't make any sense. ISM this, M2 that, and yet here we are. This is a comparison of previous cycles relative to current cycle, and you can see each cycle has had less of a momentum thrust higher, and this cycle so far has petered out. This is from the low, has petered out about where you'd expect, around 1,050 days from the low. Again, it depends on where you measure this, but you can see the returns, the multiple compression there. And should this be a high for many days, we have put in a level that has matched every other cycle. We don't have 10,000 data points here, but over the past couple cycles, this is what we've seen. So it's within the realm of expectation based on duration, certainly not what people wanted on the return side. And the other half of this is, of course, the remainder, the 200 days to bottom here ish, or more, which I have a drawdown chart in a second. But again, none of this is like immediate rosy territory for BTC. And to me, it's like, okay, let's get all the bad news out of the way. Based on the cycle, there's, to me, no expectation of highs anytime super soon. So, let all the DAT stuff explode or whatever's going to happen there. We can talk about that at the end. But let's just get through that in a bearish period, because that just makes sense to me. I don't know if you have any cycle additions here, Dylan. Go for it.
It always seems like, looking back in history, it always seems like when markets are uplifting, there's no such thing as bad news. And it always seems like all the problems that have been hidden throughout the past bull cycle, or, the last 1 or 2 or 3 years, always seem to make their way out of the woodwork and just start presenting themselves. So far this cycle, I'd say we've seen only a limited selection. Like, the characteristic of 2022 was all of the debt that had built up through all the on-chain lending and all of the debt services that had built up, like Celsius and others. So, we still haven't seen any major problems yet. No major institutions have had issues, but, considering looking at the 4-year cycle in comparison to other ones, the hour is still young in the grand scheme of things.
And as they say, when the tide goes out, you see who's swimming naked. So the tide is still going out. It hasn't fully gone out yet, clearly. And if we look at the drawdown chart there, both the depth and duration, we're about halfway, not halfway, I guess more than halfway. Percentage-wise, nothing says we have to go down another 25% from here. But if we did, that would match, again, the previous cycles. We don't have a ton of data on this. We have what we have. And it would make sense if we continue to move lower. Again, not necessarily an expectation, but just this is what we've seen historically. Anything can change anything in the future, right? We're not trying to predict the future. It's just this is what we've seen. So that's half of this. And the other half is, of course, the duration. It has taken quite a bit of time to recover once we have that mega drawdown. So at this point, I think we're past pullback and we're in a drawdown territory, certainly, or retrenchment, as they say. So if it was before 750 days from the high, that would be early, I think. And that brings us into kind of Q4 territory and then some to find the bottom on the way down, right? Because the high was October 2025. So a year from that would be potentially the low. So this would point to a potential low in Q4 and then, a slow grind recovery after that. But again, there's nothing here that's immediate or rosy just because we have seen 4-year cycles. We have data based on 4-year cycles. Anything outside of that would be new and interesting and fun, but it is not what we are able to compare against, right?
Yeah.
And I'll just add on to that, we're also seeing on one of the more important data points, which would be the ETFs, you can see those flows every day. You can see those flows every week. And they represent money being absorbed or not into the crypto ecosystem, whether it's Bitcoin, Ether, or other ETFs. But what we've seen over the past several months is a clear move outside of the ETFs. This is outflows from the ETFs. Now, that in of itself isn't necessarily going to move the needle for any given asset, but when you have months and weeks of this, yes, that is a clear signal, sentiment or otherwise, that money is coming out of this thing. Is it arbitrage from basis trade? Is it OG holders selling? It's everything. It's everything everywhere all at once, right? It doesn't really matter, but it is certainly unlikely for price to easily move higher without significant inflows. Just contrast that to 24 and 25. It's pretty clear when we're getting 1 billion, 2 billion weekly inflows, it's easier to go up, right? To me, it's that simple when we're talking about flows. Again, this is like a part of the fish tank, right? This is the ammonia, right? It might not be enough based on a range of levels, right? But if at extremes, it certainly matters, right?
And it's also contributing to other factors too, because, even though ETF flows are a very substantial amount of money, it's just one piece of the pie, because there's other cash flow avenues from the typical crypto exchanges to DATs, who are also contributing to, purchasing of assets. So the thing that makes them unique, though, is that they are the most publicly visible, set of flows of how much buying is happening or how much selling is happening, because those primary other two are much more opaque, and we don't really have visibility into those.
Something else we can look at that's kind of adjacent to flows would be on-chain data. Of all the on-chain data I've ever seen since I've been in crypto from 2013 onward, the one signal that has mattered to me is MVRV. This is market value. So market cap divided by realized value. Realized value is the average price at which coins have moved on chain. We can do this for, we can look at this for UTXO based chains, but in any event, mapping that against price, what do we see? Well, when MVRV in the red line there is, let's say, above 5 or 6, we typically have topped out, at least historically. This cycle we got to about 2.5, 3, somewhere around there. Mm-hmm. And when it has retraced, so another way to think about this is just unrealized profit. How much unrealized profit is in the ecosystem based on on-chain data? On-chain data is different now with ETFs, certainly. You can buy and sell ETFs and it won't show up on on-chain data. So it's going to behave a little differently. However, again, MVRV has pulled back significantly and it is yet to reach the zero bound level. And when it has done that historically, it has taken many months to bottom. Even 2018, in COVID, I guess would be a rare example where it sort of tapped to the zero bound and bounced from there. But that was coupled with significant fiscal stimulus that we haven't seen yet, right? So it goes back to this thing, like how bullish or bearish can you get? We're already down 50%. It looks like we're close, right? It looks like we're close to a level where it would make sense, but I think we still have a bunch of time.
Yeah, and it's also, up to monetary policy, which the future outlook, which we'll get into later, remains, one of the primary driving factors of this sort of scale. It's not just simply, as it was many, many years ago, just speculation. There's a lot more things that could go into it now. So it becomes a much more complex problem.
And if we move on to miners here, which a lot of people sort of poo-poo as like, oh, they don't matter anymore. They don't, they're doing AI stuff, or they aren't really mining, as many coins as they have historically. We can make up all sorts of excuses, but ultimately, again, what does the data show us? Well, we can look at the hash rate and we can apply a 30 and 60-day moving average. Those are called hash ribbons. That's at least this indicator, what this indicator calls them. And if we look historically, again, just visually backtesting this, is it easier or harder for price to move higher when hash ribbons are bearish? Currently, they are bearish. They're cross bearish. The slow moving average is above the fast moving average. And historically, the data would show you that it is easier to move down when hash rate is declining. And that likely means on a human level that miners are in distress. They're pulling hash rate from the network. Either they're not profitable or they're doing something else, or they're collapsing, right? I will add here that the price decline obviously plays a role here. As price declines, hash rate mining becomes less profitable, and the winter storm that hit U.S. mining corridor, sort of perfectly in the southeastern heart of the United States. That's where a lot of the mining happens outside of Texas. But even in Texas, the winter storm, this was a few months ago, weeks ago, I guess at this point, did hit that area. And that causes miners to take hash rate offline, or their power just gets cut, right? Because of what's going on with the weather. So we haven't recovered from that either. And the third thing is sort of implied, but most high level miners have pivoted to AI, HPC type stuff. So all that's good and well, if we add on color to what's going on here, the truth is that miners are struggling. If you're still mining at this point, right, most likely you are struggling as a miner.
Yeah, the price decline has impacted their inventories and impacted their margins, stuff like that. So this is another thing. We'll end up seeing who's swimming naked, and that's why we've seen a lot of these miners start to pivot to other businesses and industries. It's like, well, we have the infrastructure, so let's see what else we can do.
Yeah, we're also seeing miners like BitDeer sell their mining inventory, Bitcoin inventory to pay for AI HPC buildouts. So that is just more price pressure for another reason, right? And not only are we just giving up on mining entirely, most of these companies, but we're also selling what we have on the treasury side or on the balance book side. Again, if we look at another data point here, if we look at the average cost of production, which is sort of like this cloud underneath price, at least historically it has been, coupled with the 200-week moving average, looking at another indicator in a litany of indicators that you could look at, it gives a similar picture that we are close to a level that has been respected historically. You sort of have to be careful what you say there because we're not predicting the future, but cost of production to mine certainly is a function of whatever price is doing, but the 200-week moving average and the cost of production in this case, the bottom of it anyway, are pretty in alignment and have some confluence there at 58K. So it's possible that all the models break this cycle, right? And we go to 30K or something, but yeah, it would start to make sense if we maybe overshoot 58 and then come back to it and sort of level off there for a couple months. I think that would be my path that I'm thinking of in my head. Like, where could this go?
Yeah, and that lines up with what I said earlier. The overshoot would be to 50 or low 50s. And that would be, you in the short term, you run the stops and there's a lot of press about it was broken the 200 weekly moving average. A similar thing happened in 2017, actually. It broke through, it's not unfortunately on your chart right now, but it broke through the 200 daily moving average by about $1,000. And that caused a very short-term period of stress for the people in the market, but it immediately rebounded. And that was just a target that got broken through, but ended up being the resilient bottom.
Yeah, and if we look at, again, miners, right? We're looking at, we're inspecting the fish in the tank, right? If we look at how they're positioned on the CME, so we can see the commitment of traders data, this is published every week. If we look at it, right, it's just basic stuff. If miners are positioned X, what happens? If X, then Y, right? So the red bars here are miners either net long or net short. They're referred to as commercials. Again, I don't really care if it's throwing chicken bones on your desk every week, and this is the values you get. If it matters to price or looks like it matters to price, correlation isn't causation, but this is how TA works, right? So if we look at 2024 and 2025, 3 instances where miners were net long, price enjoyed that. Price went higher. Correlation or causation, I don't know, but there's a clear correlation there. And if we look at since mid 2025, miners have mostly just stayed out of it. They've been either net nothing, they've been neutral, or they've been, in this case recently, increasingly net short. So for BTC, to me, that means it's going to be very hard for prices to go higher, just based on what we've seen historically. This pattern follows many commodities. Jason Shapiro talks about this all the time. He's an expert on this stuff. If you want more commentary on it. And then if we move to ETH, the funny thing about ETH is we've had very little net positive. I could have highlighted more regions here, but 2 of the biggest ones I highlighted, we had very little commercials being net long from 24 to 25. And even when they were just a little bit net long, right, that was enough for ETH. If we look at now, since literally the top of prices, whatever that was, 4,500, commercials have been increasingly net short and have held that net short position for months now. So to me, again, it's obvious. It's like, okay, if the COT data looks better, then maybe we have a shot. Maybe we have a shot at finding a bottom. Maybe we have a shot at moving higher. But when you add up all of this stuff, it just feels very difficult for price to easily move higher right now. And what makes more sense to me is just time, not price. Time to just digest the bearishness, let the bearishness wash over you, and let price do its thing, because the series of data points here are not favorable for prices moving higher in the near term.
Yeah, I don't have a ton to add here, but yeah, I broadly agree. The positioning has been a problem that you've been harping on for a while. Ever since the government reopened and we started getting a lot of the data out, we were in a little bit of a black box for a period, but then it's been like, oh, this is an extremely, something of concern to be noting, and it lines up with a lot of the other macro stuff that we've already talked about. So yeah, I agree.
Yeah, so if we look at outside of technicals, outside of what's going on in Bitcoin, on chain and miners, which is, I don't think anybody's going to tell you any of that stuff's bullish based on the data, at least if they're looking at it objectively. So you put all that aside, you put that in a box, and now we look at the macro picture. And I ask anyone listening to this, is the macro picture clear in your mind, or is it fuzzy? Is the data back and forth? Is the Fed direction clear? is whether or not we get a Fed chair that's hawkish or dovish. Clear, we can talk about Warsh being a historic hawk in a Dem environment and a dove in a Republican environment. But to me, I just distill that all into more uncertainty. And if we look at the CME Fed Watch data here for meeting probabilities on rates, next meeting is less than a month from now. And essentially it's a 100% chance of no cut. When we're this close to a meeting, it's very unlikely that this decision changes, usually 30 days out. It's pretty much locked in historically. So that leaves April, and then Powell is out of the Fed chair position. And from then on, it gets a little bit more uncertain as to how fast we may see rate cuts, but the market is certainly pricing in cuts in the latter half of the year towards Q4, which again, how much of this is priced in? I don't know. How much of this is going to actually happen? Nobody knows. How much is inflation and jobs data going to affect these numbers, if at all? Maybe the next Fed chair comes in and just says, we're cutting 3 meetings in a row, right? That's possible, but there's still a lot of uncertainty on what's going on here. And I think for risk assets, that just means people are in the wait and see mode, and they're not ready to just jump in the pond and say, yeah, let's buy Bitcoin with both hands. They are waiting to see what happens, at least to the middle of the year, if not to Q4.
Yeah, I think that the important thing there is that the uncertainty relies on the fact that, okay, if we go back to, let's say, COVID, for example, we had that absolute certainty, okay, we're going to run this hot and we're going to get this back up and running as soon as possible. That becomes where everything is aligned and everything is pushing towards that. That's just another data point that, it can go either way, and it could, may most likely trend down in terms of rates, but it's not something that's going to be helping, certainly not in the short to medium term, most likely.
Right. If we get out the bazooka and the helicopter and start dropping money on people with stimmies, that's a different story. People know what to do. There's a reaction function there where people are like, okay, let's buy risk assets. We're not there yet, right? There was talk of stimmies on the back of tariff collection money. Tariffs got reversed, sort of. So where's that money? Where's the money for the stimmies gonna come? I don't know. Another thing, people have a clear path maybe in their mind of what might happen with rates or what should happen with rates, but ultimately in aggregate, what people think, I think right now it's all over the place. And it's certainly all over the place with the inflation data. If you look at real-time metrics, we have been cruising around 2% or lower for a little while now. CPI is going to naturally be less, I guess you could think of trueflation as beta to CPI, but based on the way CPI is calculated, it's going to be a little different than trueflation. It's interesting that trueflation has dove down as deep as it has recently, and we'll see if CPI follows. But another thing to watch here is yields. Yields typically have led, especially the 2-year, have led the Fed funds rate, and we saw the 10-year flirt with 4% today. Maybe it goes lower, maybe it doesn't, but that is typically a signal that the market at least thinks the Fed is either should move lower or will move lower on rates sooner rather than later. So the market is signaling that rates are probably headed lower, and we'll see how fast the Fed reacts to that. They're typically late on what they've done historically.
Though it gets a little more complicated though, because it turns into a political decision too, whether how much influence is going to be in that, whether it's going to be a purely, statistics and data driven decision. That's just adds to the uncertainty
it won't
of
be.
what the outlook.
I'll give my opinion. It won't be.
Oh, he heard us clearly now. Yeah.
Yeah. I mean, based on who Trump's going to put in there, it's probably not going to be data driven. It's probably just going to be, we need to cut for our guy, right? Which fine, right? It is what it is, but that's probably what, to my opinion, what's going to happen. The jobs picture has also been murky at best. People on the right didn't believe the data when the left put it out. The people on the left don't believe the data when the people on the right put it out. But the data is the data, and this is what we have. And we've yet to see, in that orange line there, we've yet to see a massive jump in unemployment, the unrate as it's called. Typically what we've seen historically is you don't get a recession until you get a mega uninversion of the yield curve, which we've started to get, certainly a significant uninversion of the yield curve. But we have not seen the mega jump in unemployment yet. Maybe that's AI in 2027 or something that causes this, but it's going to be hard to get a recession without markets lower and without jobs jumping higher. GDP has not put in back-to-back negative quarters, so there won't be an NBER declared recession. But until we start to see some of these other metrics move, again, because there's recessionistas out there, there's people saying we're certainly headed for a recession. It's just hard to see that without unemployment moving higher. And last thing I'll say about unemployment is the Fed, of course, is cognizant that this tends to be a runaway train, and they want to get ahead of this so that it doesn't just take off on them, right? So that's why if it starts to reach maybe the 5% level, they say, okay, now we have a reason to cut. But until then, based on the data, you would think the Fed would have less of a reason to cut.
Well, but you look back historically, they've been lagging on a lot of these things. So, even if it were to get that, maybe they give it a quarter, maybe it's transitionary, or, it's based on the action we've seen over the last while, they would still need some time, even if those levels were reached before. Okay, all right, fine, we're doing it. But yeah.
Right. And that goes back to, who's in power and who's putting the next Fed chair in power. The next Fed chair may be more political, less data driven, and just again say, I'm going to cut because I think that's what should happen. So that's something else to consider. And if we move on to as I facepalm a little bit with the M2 people, but Dylan did some work here on BTC against M2, so I'll let him take over the wheel here.
Yeah, so did some work here because it's been all the rage the last 6 to 8 months, and did some diving into it because, the expectation was early this year, as we've seen M2 cruising higher, a lot of people were expecting, price to continue trending up. Their calls were 130, 140, 150,000. And, obviously that hasn't come to fruition yet. And so we started looking back and started doing some correlation models, nothing complex, nothing fancy, but just sort of to take a look at what has Bitcoin done in the past relative to, what sort of signal the M2 has done. And when we look at it, is that it's just a simple correlation between the price of Bitcoin and the amount of M2 in circulation. And there are some signals that were given, the negative correlation that we see in 2015, 2019, and 2023/4 are certainly strong signals that, okay, there's been a pullback in the market, and this is starting to affect this correlation, and Bitcoin is no longer starting to trade like a risk asset. And those were certainly good times to be out of the market. But things are a little less clear now, as certainly, COVID threw things for a little bit of a loop, the initial spike of when the news first dropped. And then, after the big money printer started, and it's like, okay, all right, everybody, we're going back, we're bringing this back. That certainly did help assets, and we had an enormous run off of that. But, it's choppy and a little less complex, and certainly this cycle, M2 stipulated that we're just going to continue on and we're just going to keep going. We got a lot more to go because the global M2 is still going up. But in this case, looking at just the American M2 supply for this particular chart here, it looks like the correlation's falling off, and with the performance of, the last few months that we've had in Bitcoin and crypto more broadly, it certainly has come to. One thing I would like to point out, though, is that some of the data, because the data from the Fed is only released on a certain cadence, you can only take actions, at certain specific times. And we're actually to be just had another data print about a week ago. So it just confirmed that, this thing is still coming off, and we got more room to go here.
Yeah, so not only do you need M2 rising, but you also need the correlation to hold, right? So
Yep.
If you have one but not both, then you have the environment we have now, which is nothing, no environment, neutrality and or bearishness in this case. As we say on the bottom bullet point there, the bull regime looks to be ending. There was also other work done by KeyRock, a firm I hadn't heard of. I don't know about you, Dylan, but they did some interesting work about T-bill issuance specifically, not just broad M2 or broad, again, people love to look at 10,000 different M2s or all sorts of lead lag correlations. So it just depends on time frame and what data you're looking at, obviously. But Dylan, do you have any wisdom to share with us here on this graphic?
Yeah, so it was actually a fantastic article. It was very well written, and I agree with quite a lot of it. The correlation is, the data is the data. The correlation is what it is. Stats say it specifically. The only thing that I would have to point out is that on a longer time frame, the data looks a little bit different because their data only goes until 2021. And I'm not going to say it's just looking at, a very narrow point where it happens to be such a strong correlation, but, this is just basically the impulse of COVID, and it comes back out, the wave comes back out, rates go back up, liquidity tightens, and we're just sort of riding that impulse and retraction out now. So initially on the face, it looks very tightly correlated, and we have continued to trend down as T-bill issuance has, but how long this continues, I'm still not completely convinced on it yet. But it is a fantastic article, and I highly recommend it.
Yeah, I think this goes back to if you get the T-bill bazooka, if you get this just massive issuance, Bitcoin certainly gets the memo, as do most risk assets. But as T-bills have withdrawn a little bit on issuance, it goes both ways, right? You're feeling
it works as a stronger signal, right? When you have a clear, okay, we're ready to go, it works. But as things chop out, your signal gets weaker and it's harder to tell. So
yeah, other catalysts that we're looking for, because again, people are sort of wondering and looking around like, okay, what could be the next thing? The last next thing we had was basically the election, right? and that's come and gone. Outside of that, it's kind of been Clarity Act and Genius Act, which would be stablecoin related. If we look at post-election, stablecoins did really well. USDC issued a bunch, Tether issued even more, and we continue to see issuance-ish, deep into the drawdown here on BTC, and stables also act as stables also act as stimulus for crypto. I'm thinking of the article years ago that said, Tether manipulated markets and caused Bitcoin to go up. It's funny that it was probably more on the T-bill issuance than stables, but the other part of that story is it actually was more stimulative to altcoins than Bitcoin directly. So
yeah, it's just an avenue.
Will benefit. Yeah.
It's just a mechanism by which the money gets in. On-ramp, that's the word I was looking for. Thank you. Yeah.
Yeah, so similar to the ETF flows, we of course want this up and to the right forever, to infinity, because that means more money in the ecosystem. In and of itself, it's not enough to push prices higher. Look at now, right? Look at the past couple months. Look at how much Tether is issued. I'd love for that individual to redo their paper to see what the data shows here. But something to watch for, a catalyst post Genius Act passing, even clarity on market structure. What does stablecoin issuance look like? Do we see an explosion in real world assets and tokenization? This is what everyone was talking about at ETH Denver. And then is there any value accrual on the layer ones that are using those sorts of DeFi applications? Historically, it hasn't really happened. If you look at Tether and stablecoins on those chains, it's going to be a tough thing to watch if you're super bullish RWA and tokenization, and all of a sudden the RWA value is 2x the chain market cap and nothing moves. That is a difficult situation when you're expecting prices to move higher.
Yeah, and while it is, if it potentially, if that market explodes and does a 10x, it's still got a long way to go. It's still, comparatively quite small compared to the broader crypto ecosystem. Like that would have to take, it's got a lot of shoes to fill.
Yeah, no, I think the issue here is scale. Like the scale just needs to be so much more to really matter on the L1 side. Another catalyst, this sort of plugs into M2 and global liquidity as well, is US dollar. US dollar weakness followed a similar path to Trump's first term in the purple there. And at this point, we've sort of, at least in 2018, as you saw with the cycle chart, the cycle was over by this point, right? And so has in Trump's first term, so was the dollar weakness. similar here, USD weakness kind of has stopped at the moment. So another catalyst to watch for, and metals have certainly picked up on this, if there's expectations of the dollar to move lower, eventually one would think crypto would get the message. So if I'm making my catalyst checklist, this would be another one. Can the dollar continue to get devalued based on the DXY? That's what I would look at. If, for example, we see like a sub 90 DXY, there may be a point at which a catalyst emerges where people finally say, okay, on a relative value basis, metals are up here, crypto's down here. Maybe it makes sense to start buying some digital assets.
Well, I also have to think, though, is that crypto is not necessarily the riskiest of the risk assets, but if there's going to be any list, it's certainly going to be high up on it. And so, whether or not they're going to be the first to move or last to move, once those things start happening and those dominoes start falling, I'd probably wager that it's going to be later on the curve. Look at 2020, crypto went up and rallied, yes, but equities were rallying months before crypto had any serious move.
Yeah, and just another correlation to watch. There's so many like things here that that either are obviously not working or are obviously just in lockstep. And this is one of those things that are just connected at the hip that many people have discussed here over the past couple of weeks. Is the IGV software ETF has just puked lower in a big way, and that has basically correlated 1-to-1 with Bitcoin price. So something to watch here. The first is, can IGV catch a bid, assuming the correlation holds? And number two is, will this correlation break? When? Why? Is this AI related? Is this quantum related? Is it both? Will Bitcoin get the memo and figure out a quantum solution? Is that a catalyst to watch? That doesn't look like it's something that's going to happen in the near term, but 3 to 6 months from now, we may miraculously come to a decision and get some quantum resistance. But until that time, these just something else to watch.
Yeah, and I think more broadly speaking, it's probably a similar pool of capital. It's money chasing after similar assets. So, just as altcoins are correlated to crypto, or Bitcoin, excuse me, you go down the stack and basically everything trades like Bitcoin. This is a fairly similar market with similar participants, similar people, etc.
Yeah, the big pools of capital are certainly treating it the same. DATs came on the scene in a hot way last year, summer and into fall. Most of them at this point have deflated. I'll let Dylan explain MNAV, but the TLDR here is all of these, on aggregate, for the most part, are now below their market cap value relative to their treasury value. So that means an MNAV below 1, basically they're at a discount. If they act as closed-end funds until sentiment returns in a bullish fashion, I would expect these to continue to hold below a MNAV of 1 and probably just flounder down here and continue to sort of decay. What do you think, Dylan?
Yeah. Well, I think that, the comparison, if you want to do a little digging in history here, the comparison is always to GBTC, because that's the largest closed-end fund that crypto's ever seen. And that had a very similar, for different reasons, but similar premium and discount curve of premium when the price is going up and people are flowing in and money's flowing in, and then discount once there's less of an appetite for that particular product. And we've seen a pretty similar curve across all of these DATs. As like you said, DAT summer last year, it had incredible amounts of inflows from strategy all the way down the stack. And we've seen a lot of that come off now. The smaller ones have started selling. We've seen some start selling some of their treasuries to either rebuy shares or pay off debt. But for the most part, the industry has held together. There's still an enormous amount of assets within custody at all these. And so, as long as they don't get into leveraged positions where they start having decisions made for them, I agree that they'll just end up trading like closed-end funds at some sort of discount or maybe even a premium again, depending upon the broader market cycle of how crypto is doing.
Yeah, and I think everybody's asking, like, what's the signal here? How low is enough on, let's just pick one. We'll pick MSTR, right? How low is the MNAV going to go, what makes sense here, and based on GBTC, again, even if we look at MSTR, a 60% or 0.6 MNAV, however you want to think about that, could be the bottom. But ultimately, it sort of depends on correlation with price. And if you're turbo bearish BTC here, you're probably not turbo bullish MSTR, even though MSTR has been gaining on IBIT, for example, over the past couple of weeks. It's very difficult when you're in it, when you're in the thickness of uncertainty, I think, to be brave here, unless there's an obvious dip lower in MNAV.
Yeah, and
Dylan,
it's a momentum
where
instrument.
where would Dylan buy MSTR here, for example? Would you be looking at MNAV, or would you be looking at Bitcoin price more?
Probably Bitcoin price more, because it's a momentum instrument, right? It's levered Bitcoin to a degree. And while some of it relies on community sentiment of, what people believe that the strategy and their future outlook looks like, at the end of the day, it's still a levered instrument due to all the stuff that's built on top of it for at least strategy. Others are different, but we're not going to get too deeply into that now. So I would just say that the perspective on Bitcoin probably is the foundation at which you would form then an opinion. Okay, is there going to be exposure here? Do we want levered exposure, et cetera, et cetera? Though you do have to also keep in mind that these DATs function as a regulatory arbitrage mechanism. They allowed capital to flow in from other areas that otherwise were unable to buy either crypto directly, or any of the exchange traded products, or their broker wouldn't let them because they have a particular type of account, and so it was acted as a proxy for that. And that moat, it is slowly getting eroded away as time goes on. And so that pool of capital that would want to be attracted to it or have no other way to gain crypto exposure is slowly shrinking over time. And so that's another thing to consider for the prospect of that, because you need more buyers to purchase the assets so that the DAT can continue growing.
Yeah, and we're a little over time here, so I won't go deep on the pref shares, but I'll just say my personal favorite is STRC. I don't really pay attention to the other pref shares. I know a lot of people are very curious on the differences between STRK, FDC, but for me, it is the highest yield. It's a variable rate. It says a monthly dividend. I don't know what else do you want, right? I don't know if you have
It's
any
most liquid.
It's the most liquid. I
Yeah.
don't know if you have any quick descriptors here for people, Dylan.
They just sit at different levels in the equity stack. Some are more senior than others. Some are paid a little bit differently. There is a lot of nuance to the differences in them, but I agree, over time, perhaps a slide for another time.
Yeah. And we will leave it there. Hopefully we gave everybody a lot to chew on for the next couple months, but we will be back here with another webinar next month. In the meantime, you can contact us at info@canary.capital or check us out at canary.capital. Thanks, everybody. Take care.